The stock market just seems to keep going up. Why? There's a really interesting thing going on at the moment. We've obviously got the ongoing crisis in the Middle East. There does seem to be an element of perhaps resolution to it, but it's by no means done and dusted. That being said, what has happened in the stock market in the past few weeks is it seems to really have actually powered on. This is what we're going to be exploring today on the latest episode of Investing Stakes in partnership with Stratiphy. We're going to be looking at why is it that even though there's still global uncertainty, volatility, we don't really know what the outcome of these kind of situations are going to be. The stock market seems to be looking through that and moving ahead. Now, to really understand the dynamic here and what this means for wider portfolios, plus for those of you who've been watching before, what that means for our own Stratiphy portfolios, I am joined as ever by my good co-host, Chris Chu. Hey, Chris.
Hi, Ed. How's it going?
Brilliant, thank you. And I'm joined, of course, by Chris Ling, who is Chief Investment Officer at Stratiphy. Chris, hello, how are you doing?
Yeah, hi Ed, it's good to be back and discuss where things are going.
Yeah, so a lot of really interesting updates on our portfolios. But before we come to that a little bit later, we are going to be looking at why is it that the stock market seems to, and investments in general, seem to look through these issues. What is the dynamic at play here? And what can we learn from that? Investing Stakes is done in partnership with Stratiphy. Stratiphy is a brilliant investing platform and app which uses algorithmic quantitative-based methods to invest its strategies for you. It's a bit different to your typical DIY investing platform in that it uses mathematical equations and algorithms to figure out a strategy based on your preferences. Chris L., you've got a really interesting update for us this month on some new functionalities and actually a new ISA product that's now been added to the platform. Is that right?
Correct. Yeah. So, quite exciting. The end of last week, we've managed to launch, and I think we are right to say we are the first in the UK to launch the IF ISA for enabling crypto ETNs into an ISA wrapper. And so the big advantage now for investors is instead of having those 1,000% gains or whatever they might have had in Bitcoin, can now, if they materialize in the future, of course, investing is uncertain. Those gains can be nicely now inside a tax efficient wrapper, which is not quite the same as a stocks and shares ISA. It is slightly different, but it's called an IF ISA. And at the moment, people can take their money to the Stratiphy platform, invest it in an IF ISA. And there are a couple of ETNs we've got there at the moment, and you can put those in strategies created by Stratiphy, and we've so far partnered with 21 Shares, who are probably the leading ETN provider in Europe for crypto ETNs. So they've basically got the longest track record, largest AUM, and so we're very excited to launch with those first few products, and there'll be more coming along onto the platform shortly, very soon.
Yeah, so obviously it's really important to mention that your capital's at risk when you're investing in any kind of assets, be it through the new IF ISA on the platform or general stocks and shares ISA. But I think what's really interesting with this new product is it's taking something that's been around for a little while, the Innovative Finance ISA, and actually repurposing it, because although HMRC, the government, allowed people to invest in these crypto ETNs last year, they have actually made changes to the rules about where you can hold them. So the reason why Stratiphy has now got the IF ISA on its platform is because that is where you now have to hold these crypto ETNs if you want to hold it inside an ISA wrapper, a tax-free wrapper. So that's really cool, really interesting development. Do check out the app. We've got a QR code for you to follow the link if you're watching on your TV. We'll put a link in the description as well so you can find out more. Really great product, and obviously really interesting to be the first one in the UK launching that. Now, let's get into what we're going to talk about today. Why is it that the stock market seems to be looking through all of the concern in the world out there and all the uncertainty? We're going to start with the current situation. Chris L., what is your kind of feel of where stock markets are at the moment in terms of seeing all these issues that are going on, but they seem to be powering through that, right?
Yeah. It's been an interesting few weeks. So I think almost around about the time the last podcast, I think we were at that almost inflection point where markets were hitting that trough. So they'd have been absorbing the worst of the news coming out of the Iran-US conflict. And I think really just digesting where it's gone. And I think markets in a way kind of begging for some sort of resolution and looking for that signal. And then talk started to come about between the US and Iran, and then ceasefires started getting mentioned, and that started to put markets at ease. And so when you get that shift in tone from governments, the geopolitical risks start to decline somewhat, and then markets start to look through more at company fundamentals again. So particularly what we've seen, I think, from US companies is that now moving on to April, we're starting to move in towards earnings season. And then the markets are getting much more focused on what's going on there. And so far, the earnings information coming out of the US has been very positive. Most companies are beating the market expectations. And so there's almost a tendency for markets, I think, to forget that sort of geopolitical tension that's going on. It's kind of, it's bumbling away there in the background almost. Nobody's quite sure exactly what's going to turn out, but markets hedging a little bit and going, it's probably going to be okay. This company's still rocketing earnings, so we've got to respect that and give it a valuation that justifies the multiples.
Chris T, how do you feel about things at the moment? Are you worried that things are too positive? What's your sense of it?
I wouldn't say worried. There is a sense of it, markets having defied gravity for me. Maybe it's just my sort of general pessimistic soul. I'm quite different to you, Chris L. I think I have to deal with the lowest common denominator in terms of what could go wrong, will go wrong, and then build from there. But I think I have been a little bit concerned that they're a bit frothy, and I think this has played out in the AI conversations we've had, where I've just felt that actually some of the valuations there are divorced from reality. And this is the major kind of schism in our differences in terms of our portfolios, which we'll see over time how that plays out. And I think there's some changes this month already, Ed. But no, I am a bit concerned that slight overvaluations. Then there's been the kind of corrections that you would expect with geopolitical tension, but then this massive optimism around they'll probably just work that out, even while it seems Strait of Hormuz remains closed and nothing's flowing through it. I was thinking about sort of events before that would have spooked markets maybe 10, 15 years ago, now just don't even check its stride. They just keep going. So yeah, it's an interesting one, because either people are just more strong on the fundamentals of where these companies are going, or these geopolitical events are just seen as the norm now, and eventually we find a way of kind of shrugging them off collectively and getting on with where we're going. So I'm not worried per se, Ed. I just not entirely sure that the trajectory will continue to be up. And that's why on my Stratiphy portfolio, I'm focused on what I think are the main building blocks in the medium term of, or even slightly long term of, our global economies, which is infrastructure, oil, gas, and all the stuff we need to build things continues to be important.
Yeah, I think we're really interested to hear any thoughts anybody has on this topic. Do share your views in the comments with us. We do try and read them all and reply to them too. We did actually get one really interesting comment recently from a long-time viewer who said that he was concerned that it's giving him an uneasy feeling of constantly just buying the index when things seem to be riding high and almost nervously exuberant. It creates that kind of sense of ill ease at it. Now, obviously, we can't indicate what future performance is going to be like based on what's happened in the past. But Chris L., there is a mechanism here, right? And something that markets do, which is markets have that period of volatility where things go down and you have those short, sharp drops. But in the past, we have seen that it recovers from that and it moves on. So what's the wider thing going on here in that sense? What can we learn from that?
Every sort of market downturn is a bit different to the next one. But there are a couple of different types of downturns you see. What this has effectively been a bit like what we saw last year, is a kind of market reversal happening. So you get one bad negative month where basically the markets are trying to understand what bad news has just hit, and the bit of panic, and it's the kind of what if things really go bad. And then after a period of a month perhaps, and this is a sort of the terms of reversal is quite well scientifically covered from historical data, but what tends to happen is, although not all the time, markets get a sense of where we're at after 1 month and then go, actually it's not as bad as we first thought it might be. And then you see the reverse happening over the next month. So whatever the sort of downward move in March has been, quickly gets reversed and backed out by the markets the next month. We saw that in April last year. There was quite a quick swing from, again, geopolitical led tensions back then with tariff wars. Actually, at the moment, the trading patterns this year are looking fairly similar, not perhaps quite as deep as they were last year. And another one, even going back to there, again, we saw deeper drawdowns of sort of 30% in a month. In the space of a couple of months, that was fairly quickly reversed out. So there's examples where you get fairly short, sharp drawdowns in markets. Something that is more protracted and takes longer to bake in is another type of drawdown. So like the financial crisis, there were big drawdowns at that point, but it took a sort of 18-month period for that to really through the full extent to the financial markets. You can never rely on reversals happening each time. So does that necessarily, after one bad month, does that make it a good time to buy? Possibly. The markets go down for a reason because they think it could get worse. And of course, it could always get worse and go down. So nothing is certain with these things.
I think this highlights a really interesting point, actually, about the Stratiphy strategies that is a bit of a differentiator here as well, is when you have that period of short-term kind of fear and people, what you're seeing when those indices go down is investors reacting with an element of fear, or if you're being a bit more technical, de-risking. And there's a temptation, isn't there, to sell something where you feel, oh, no, I can't, this is a crisis, I've got to sell these investments, that kind of thing. What's different with Stratified strategies is it takes that out of your hands, doesn't it? It manages it in a way that's systematic to neutralize the issue, perhaps.
Yeah, I think to that particular investor's concern, I think it's very valid because it's what a lot of people feel. And it's kind of what we discussed in the last episode is that sense of fear and uneasiness often persists for longer than the market sort of accounts for it. And so the problem is if you have gone through that, oh, I don't like this right now, I should sell, the market's bounced back before you're ready to feel at ease again, that market conditions are benign enough to go back in, and the market could be up 10, 20% before you feel, yeah, things have calmed down a bit now that I'm ready to go back in. But having taken that decision to sell and then buy back, you've effectively tried to market time and lost out. Hence why sitting on your hands and understanding your long-term strategy and doing nothing is really quite a power move compared to what many investors in the market can handle. So that in itself is quite a powerful way in outperforming what many others end up experiencing in their own investments.
I think with that in mind, it is time for us to look at our strategies and see how we are getting on. Now,
you're more keen to look this time, Ed, than last time.
I'm very excited for this, Chris G. I will remind viewers that in the last episode, if you haven't caught that, it's worth having a look at it. I was behind. My strategy had taken a bit of a hammering by the crisis that we have been discussing. But Chris L says, I sat tight. Actually, the Stratify strategy sat tight for me. So let's have a look. So here we are with our current portfolios. Now, we have got Chris Tute's Beige Fox, Ed Greaves' Black Elephant, and we have the Stratify Self-Confident Mole, which is our kind of baseline tracker. Plus, we've got a couple of indices here. We've got the S&P 500 and the FTSE 100. Now, this is our kind of ongoing performance since we opened the portfolios way back in February. And as you will see, I have taken a slight lead, Chris T. It's very small.
Very slight, very slight. Yeah.
It is there.
It is quite a swing from where you were, Ed. It is
know.
Quite a swing. This is the thing I've noticed with these portfolios is that the change is marked at different points, which is reassuring from the decision being made. Sorry, Ed.
I do think that is really interesting because, and it's important to highlight at this point that each of these portfolio, these strategies, is using a different strategy approach. Chris T's got MACD, MACD. I've got moving averages, and then the Stratify's portfolio is based on momentum. Do you just want to give us a really quick overview of kind of the differences there and why that's creating slightly different outcomes here?
Yes. Part of it is different type of strategy. Part of it is the underlying sectors that you've chosen. Chris's biggest differentiator is probably the sectors he restricted himself to. So Beige Fox is perhaps an interesting name for his portfolio because it's been quite steady and not moved around so
I think
much
you're calling me
the,
boring, Chris. Is that what you're calling me, boring?
I never said beige was boring. But no, so I think momentum here, and so moving averages should be the least active in terms of how many trades you're going to see. And I think Ed, that's correct from your portfolio standpoint. You haven't actually had any trades yet. So what it's not doing is listening to too much short-term noise in the markets and waiting for a slightly bigger trend move before it makes its changes. Chris, on the other hand, your MACD is really looking for those quick changing dynamics in the market. So it might be that something is just starting to feel like toppy, like it's just running out of momentum. So it's looking for that change in the deceleration effect. It will try and sell those holdings that are decelerating quite quickly and then invest into ones that are more on the acceleration phase. And so where that goes right quite often is in something like this, where you've got these kind of reversal. It is picking up in some of those changing dynamics and will trade the portfolio accordingly.
I think that's had a really interesting outcome, hasn't it? Where between Chris's portfolio and my portfolio now, where I have 10 holdings and that hasn't changed at all since I opened the strategy. But Chris T's, he's now got nearly double the amount of holdings.
18.
He's got 18 holdings. And so it's made a choice there, hasn't it? While kind of stuff's been ongoing. So what's going on there? Why has Chris's moved in that way?
So it's taken those decelerating stocks and it is basically replaced. Okay, so what am I taking out of the portfolio? I don't want those now negative MACD score stocks, and it's putting in their place basically the 10 best that it can find to replace it with. So hence the extra number of shares. That does mean those shares are quite well diversified in not being particularly large holdings, but they've just happened to represent the strongest movers at the moment. But yeah, it does give you a nicely diversified position on that front.
It does really tell two very different stories, doesn't it? If you look at that kind of green, if you look at that green line there, that's Chris's slow and steady performance. And we've got a few kind of dates here to do with kind of the crisis ongoing. But you look at mine, it really headed south for quite a long time, but it's bounced back harder as well, isn't it?
Roller coaster, Ed. A roller coaster.
Yeah. That's telling me not to open my app because I'm just going to get worried a bit too often about what's going on. But the thing is, I'm back in the green here,
steaming ahead.
You're basically the biggest mover since is your tech sector there, and Google's your big holding there, and that whole sector has bounced strongly in the whole sort of raft of news around the hyperscalers increasing their capex this year. It's showing depth to the AI infrastructure cycle. It's not completely running out this year or next, and it's reassured markets that's going to continue. Whereas last month there was, is the world changing again? Are we going to be heading to recession? Is everybody going to be scaling back? And therefore these very forward-looking companies were being put on hold for a while. So we've seen the AI infrastructure companies, they've lagged for 6 months since the end of October last year. But their earnings have still been accelerating. They haven't really slowed down. So you've been seeing a real price to earnings compression on those stocks. And now the market's having to re-rate it quite strongly. Alphabet there has been one of those beneficiaries.
It's quite interesting, isn't it? Because when we set these strategies up, Chris T's portfolio, he set that up in mind with, you wanted to have a bit of a focus on energy and you wanted to avoid some of the tech. And that's been good for you. But then I did the opposite, and the energy's been good for you because the nature of the crisis has been basically good for oil stocks because it means that there's more scarcity. Mine's been the opposite, where I kind of backed heavily tech, and tech is what took me down, but tech is what has also picked me back up. So it's quite interesting, isn't it, how two quite different approaches. Well, it's that kind of long-term thing, isn't it? Everything just reverts to go to the original narrative.
Yeah, exactly. And it's just the way the different kind of momentum strategies are going to pick up these factors. And, perhaps the AI infrastructure story isn't one that was broken necessarily. And so, and your slightly longer-term trend-seeking strategy is still on board with that. And so it's held fire with Google, even though it had a pretty tough month or two. And was dragging the portfolio down a little bit, but it's been right there in the bounce back, these things can change very quickly.
Now, looking ahead, Chris T, are you comfortable with where you are at with your portfolio and looking forward? Are you happy with where it sits?
It's not in the nature of the Beige Fox to panic, so I'm going to relax and see how things play out. I think there's this is what the issue in the Middle East is about, is long-term energy security and hard economics, I would call it. And it's not just on the kind of oil and gas side of things. I've got stuff. There's other infrastructure plays there, some stuff that might feed into the defense sector, pharmaceuticals, financial services, all those kind of old sort of faithfuls of the stock market is where I think my money's best served at the moment. I take the point on the AI thing, and I feel like I'm always coming on here and talking about this, but in terms of, there were very serious discussions about the capex spend around some of the AI firms out there, and I'm not convinced by that over the long term. So I'd rather invest in what the economy has known down the years, and I think over the period that we're doing this, it's going to deliver better returns for me and nice and solid, get me to where I want to be. And then maybe we can look again once there's this bit of a shakeout, but I'm not convinced that shakeout has passed us by. I think there's going to be some changes in that AI sector, and that might have a little bit of impact on your numbers moving forward. But no, generally, I'm happy with where I am. I think probably the other things I'm starting to think about in light of what's going on is maybe thinking about some green technologies, whether there's anything in that as nations look towards energy security. I think that's going to be perhaps another growth area in the not too distant future. So just diversifying more in that kind of energy sector is where I'm thinking about the long-term future. But at the moment, I'm happy to stay out of the AI discussion and to stick with old faithfuls. What about you, Ed?
I don't think it's doing you wrong. No, I'm confident where I'm at the moment. I think I'm probably more bullish on the kind of AI tech side of things. I think it's going to create disruption like many new technologies do. But I think actually, for me, it's even in my own kind of professional experience now, it feels more like it's creating more productivity as well. There is a lot of money being poured into it. That's the nature of tech. It requires a lot of cash to build the thing.
Yeah, I don't think it's not going to disrupt it. I think what I would say is that I think that the scale of that disruption has perhaps been overstated. That's my take on it. There's no doubt that it's changing a lot of the way we work, and I'm involved in some things in my own sort of day-to-day life which show the power of what this is and how it's changing the way that I work in my professional life. I just think that capex spend I can't get away from, burning through a lot of money on infrastructure that maybe we don't need. So that means there could be write-downs coming in the future, and I don't want to feel that pain. I don't want to open my app like I do, as we've established, every 2 hours and see a massive red line going down. I want to sort of stick to some old faithfuls, and I think there's enough of an argument around what's going on around that kind of hard infrastructure stuff at the moment to say that's still going to be relevant and there's still returns to be had there.
Chris L., any kind of final thoughts from you where we're looking moving forward now and even moving into the summer months?
It does feel somewhat like we're looking into the crystal ball here.
Of course.
But I will keep my bullish tone from last month. I know members of the Bank of England that have come out and told us all that markets are overvalued, and in some ways they are, but I remain bullish on equities. I'm with you, Ed. I am a believer in the AI infrastructure cycle, and the AI is actually providing very good value. I use it quite a bit myself, and it enhances my productivity. If it's doing that for me, then I can only think that's going to extend to the rest of the world quite soon, in quite a big ways. Yeah, I am the eternal optimist.
Brilliant. Like we said earlier, do let us know your thoughts on the AI tech trend, whether there's a place for oil and energy in your portfolio, what you've been doing recently to stay on top of things and make sure you're not panicking. We'd love to know what your approach is, and whether you think our approaches are wrong or right. We welcome it, and we'd love to keep the conversation going. With that, I shall say thank you to Chris T, as ever.
My pleasure, Ed. Always a pleasure.
And thank you to Chris L for being yet again the wise words for our hotheads to
much needed.
Cool off.
Thanks for having me, guys. Yeah.
Brilliant. Thank you, everybody, for tuning in. We shall see you all again very soon. So with that, thank you and goodbye.